Hi, my name is Carol from Provident Credit Union. Thank you for joining us today, where we will be discussing managing student loan repayment. This webinar is being recorded. All attendees will receive a follow-up email with today's recording and a presentation deck within a week. All participants have been muted, so please use the Q&A box for any questions, and we will answer at the end of the presentation. Your presenter today is Jeff Lackey. He is the Director of Relationship Management with Salle May. And with that, I'd like to now hand it off to Jeff. Welcome, Jeff.
Thank you, Carol, and welcome everyone. Thank you for taking some time out of your day to attend this presentation. Obviously, this is if I'm going to do a little assuming that maybe by chance you've recently attended graduation, or you are going to be thinking about, or you're going to be attending graduation here in the short next couple of weeks or so. Or if you just happen to have separated from school for a while, maybe had to have taken a leave of absence, you're just kind of wanting to refresh yourself as to some of the features and benefits of some of the loans that you may have taken out, understand a little bit of your rights and responsibilities and some things that you need to be aware of if by chance you're heading into repayment. So I appreciate you taking the time and being dedicated to knowing what the next steps are for your loan repayment future. And we've got a lot of information to cover. I'll be more than happy to answer questions at the end of this. We're going to try and get through the information as quickly as possible, or as efficiently as possible, but still be able to make sure that you get a lot of information that we think would be very useful for you as you move forward. So, having said that, let's go ahead and get started. Some of you might be saying to yourself, I know I've taken out student loans for college. I just can't remember what type of loans we have and whatnot. So there's basically going to be two types of loans that you primarily would have taken out in order to fund your education related costs at your college or university. They're going to come in the form of either a private loan or a federal loan. And they're not going to be the same. However, a loan is a loan. So a lot of the concepts, if you think about interest, you think about principal, so on and so forth, those will all be the same. But as far as some of the features and benefits, they're going to be different. And we'll explain what some of those differences are. And if you simply just can't remember what type of loan you have, as we kind of go through some of these differences and different features and such, maybe that will help jog your memory. And then we'll tell you obviously where you might be able to research this and know a little bit more definite as to what type of loan you have. So basically, the difference between federal and private loans, the first one, the large glaring difference between the two is one is funded by the federal government. The other type of loan is funded primarily by banks or credit unions or other types of lending institutions. On a federal loan, because it is supplied by the federal government, Congress does set a lot of the different features, benefits, the rights and responsibilities, so on within that particular loan. They particularly have set for the federal student loans a fixed interest rate loan, meaning that every July 1st of each year, and so if you think back maybe 4 years ago, for your first year in school, you would have taken, if you have taken out a federal loan, it might have been called a subsidized or unsubsidized direct loan. It would have had a fixed interest rate for it. At the time it is assigned what the interest rate is at the time that you take out that loan, and it will be that interest rate for the duration of your repayment period. Then the next year, your second year, interest rates might have changed, but it would be fixed for that particular point for that particular year, and that rate would be set for the life or the duration of the loan. You do need the FAFSA in order to fill out or in order to be eligible for a direct subsidized or unsubsidized federal loan, as well as other types of federal loans. Whereas with a private loan, because it is supplied by a bank or a credit union or other type of lending institution, you do not need the FAFSA, the free application for federal student aid. Because these are offered by private lenders, lenders can offer a choice between variable or fixed interest rates. So whatever seems to work best for your situation will allow for you to dictate what type of interest rate you would like to have. Because on average, private loans are going to be credit based, meaning that we have to take a look at your credit in order to make a determination on approval or denial, as well as some sort of an establishment as to what the interest rate would be. You may potentially find yourself needing a cosigner for the loan. And a cosigner is somebody that essentially co-applies on the loan with you in order to give you a better chance of being approved. Or if you were approved for a loan, but maybe you wanted to see if you could get a better interest rate on that loan, you may invite a cosigner to see if that will help boost your credit and get you into a better interest rate environment. So as I mentioned before on the previous slide, federal loans typically will come in the form of a direct subsidized loan or a direct unsubsidized loan. Both of these are going to be the same program, but they are going to have a couple of different features. Some of the most notable features is that a direct subsidized loan is going to be for students that have a demonstration of need. So when you fill out the FAFSA and you receive financial aid based on the information that was on the FAFSA, if you still have need with what the college or university was able to build for you in a financial aid offer, if you still have need, meaning they weren't able to cover all of your expenses with what we call gift aid, which is grant or scholarship money, you essentially have need and you can receive a subsidized direct loan. If you, at the time of receiving your financial aid offer, almost all of your expenses are taken care of with either gift aid or other types of outside aid, and you do not demonstrate any need, you may still find that you are eligible for what is called the unsubsidized direct student loan. And the big difference between those two is that one will actually have the interest subsidized by the federal government, meaning the federal government will pay the interest on that loan while you are in an eligible deferment. And an eligible deferment would be like an in-school deferment or an economic hardship deferment or military deferment. If you happen to qualify for subsidized loans, anytime that you do enter into a deferment, the government would go back to picking up the interest. On an unsubsidized student loan, you, the borrower, are responsible for the interest for that loan for the duration of the loan period. So basically, once that loan is approved and it is dispersed out to the school, you are responsible for the interest on that loan. So as it accrues, you would then essentially have to pay it along with your principal payments on a month-to-month basis. These loans are eligible for students that are at least half-time status. Both of these loans are. You cannot be in default on any other type of federal aid programs, whether that includes gift aid like Pell Grant, or default on any other type of federal student loans. And you need to fill out the FAFSA, like I mentioned. As long as you hit those requirements, you have eligibility for either a subsidized or an unsubsidized direct student loan. For the graduate side of things, this is going to get a little difficult because we are less than 20 days away from some major changes that are going to occur for graduate students. But right now, as it is for students that are currently in graduate school and plan to remain in graduate school moving forward, right now, currently, you have eligibility for two different types of loans. One is the direct unsubsidized loan. This loan is getting a few modifications and enhancements for July 1st, after July 1st. However, this loan will still be available for graduate students. It will work much similar to the undergraduate unsubsidized direct loan, meaning that you do have to fill out the FAFSA, you need to be attending school at least half-time status, and you do not need to show financial need. There is no subsidized direct student loan for graduate level students. So this loan is available to you. Depending upon your program of study, you could be eligible for up to $20,500 per year or up to $50,000 per year in this particular loan. Now, for those of you that are in repayment, you may find that you've had one of these loans and that you had different loan amounts for each of the years moving forward from year one to year four. If you have entered into graduate school and you've taken out either an unsubsidized loan or so, you may find that your loan limits once you entered into graduate school went up. These do have aggregate limits, and so from that perspective, you may have differing amounts that you took out each and every year while you were attending school. For those of you that had a graduate plus loan and you are graduating out of your graduate program, congratulations, you were able to borrow under this program for the full portion of your schooling. If you are an undergraduate student and you're thinking about moving into a graduate program, you've just finished your undergraduate and you want to start into a graduate program, you may not have this loan available to you depending upon whether or not the Department of Education determines you as a legacy student. So if you are just now starting your graduate program and you have not received any federal loans for your current program that you are moving into, you would not be eligible for the Graduate Plus program. However, if you are currently enrolled in a graduate program, let's say your undergraduate program ended a month ago, you've started into your graduate program already, and you've had a disbursement of loan prior to July 1st, you would be considered a legacy student and you would still have eligibility to borrow the Grad Plus loan for your remaining program. And I would check with your school's financial aid office to let you know what that remaining eligibility would be. However, if you are at the end of your graduate program entering into repayment, the Graduate Plus loan was the loan that you had. It allowed for you to borrow anything above and beyond what you had received in form of financial aid up to the cost of attendance. So if you knew what the cost was to attend school, you received an unsubsidized direct loan and maybe you got a $500 scholarship or so, you could use the Grad Plus loan to fill in the remaining gap in order to meet the costs of your program. Some of you may have borrowed what is called a private student loan. We covered that on the first slide. These are the loans that are specifically designed for college financing. They are an education-based loan. Again, they are funded by banks, credit unions, and other finance companies. Because they are offered again by different entities, they may have different features and benefits. They may have different rights and responsibilities, different interest rates, and such like that. Your promissory note, and we'll talk a little bit about a promissory note in the future, but your promissory note is basically a document that you would have signed at the time that you obtained one of these loans. And that promissory note is basically going to be all the rules and responsibilities at that point in time that you signed for that loan. You'll want to make sure you have a copy of that promissory note handy. And we'll talk about some of the other things that you ought to have available to you in the future in case something came up or you needed to reference some of the information in regard to your loan program. If your loan was co-signed, you may find that depending upon what lender you chose or what financing institution you chose, there may have been a possibility that you could have the co-signer removed from your loan if after a certain amount of time, let's say like 12 principal and interest payments or something like that, or maybe a little bit longer, but after a period of time of you establishing responsible repayment habits and that you've been in your position or career for a certain period of time, you may be eligible to file to have the cosigner removed from your loan. And again, on a private student loan, you may have had to have had a cosigner, and this is potentially an option that a lender would have offered you. So that is something you may want to check. And again, your promissory note would have the information on that or your lender's servicing website. So right now, currently, with a private loan, when you first got your loan, you were basically able to choose whether you wanted to make payments while you were in school, or you could have deferred your loans entirely while you were in school. Whatever your choice was, you will still have that choice through what is called a grace period. So you can look here on this chart. You will see that if you decided to defer your payments while you were in school, you were not required to make any payments while in school. When you start into what is called a grace or separation period, the federal student loans, as well as some private student loans, allow for what is called a grace period, which is a period of time from when you leave school to when you have to start making your payments. And on average, this is about 6 months for the federal student loan programs at 6 months, and most lenders will offer around 6 months, maybe a little bit more, depending upon your program of study. If you've deferred your payments, there is no responsibility for you making payments while in school or while in your grace, but at the end of month 6 and starting into month 7, you will have to start making principal and interest payments until the loan is completely paid off. If at the time that you accepted your loan way back in year 1 of college and you decided that you wanted to pay the interest while you were in school to kind of help cut down on loan debt, you had to make either a fixed amount payment or pay the interest while you're in school. When you enter into your grace period, you will still be required to make your fixed amount or interest payments while you're in school. After that grace period is up, that 6 months, and then moving into month 7, you will also too start into making principal and interest payments. Principal being the portion of the loan that you initially borrowed, and the interest is basically the cost of the loan. So from that perspective, again, interest is going to be the amount that you were charged for borrowing the money, and you had the option to pay that while you're in school on a private student loan. Many lenders offer this as a option. What it does is helps cut down on the amount of interest that capitalizes throughout your period of study, as well as keeps the overall principal of the balance accrual down when you start into principal and interest payments. Your principal is the amount that you borrowed plus any unpaid interest that has been added to it. And we'll talk a little bit about interest capitalization here in a second, but many times that if you have, let's say you borrowed $10,000 or so, once that loan is dispersed out, interest starts accruing on it. What a lender does in regard to whether they put that interest that accrues and they add it to the principal immediately, so month to month they add it, or do they keep the interest and the principal separate until a future point in time and then they will add them together? That will determine whether or not, when you enter into repayment, if your principal is still what you have only borrowed over years 1, 2, 3, and 4, or has your principal changed because of it takes into account the amount that you borrowed plus any interest that the lender added to that while you were in school for years 1, 2, or 3, or 4. That will determine how fast your principal has grown and subsequently how much interest is accrued on a loan over a particular time. So, excuse me, the interest rate is essentially the rate that is charged to you to borrow money from a bank or credit institution, a credit union, or financial institution. Obviously, the higher the interest rate, the more the total loan cost of that loan could be over time. Interest capitalization is essentially what I just discussed. It's basically that point in time when a lender takes the interest that is accruing on your loan and adds it to the principal. Sometimes lenders will add that immediately, month after month. Sometimes lenders will wait until a student fully enters into repayment. And sometimes maybe lenders will do it quarterly. Your promissory note will describe to you when a lender will add interest to the principal. Typically, on average, if a lender has a longer period in time between when you borrow the money to when they add the interest to your loan, that on average will save you a little bit more money. So essentially, a bank or credit union or institution that capitalizes or puts that interest towards the principal in a faster or more repetitious process tends to have your interest grow faster, which means a little bit more money that you would have to pay back over time during your repayment period. Lastly, repayment incentives. This is something that is a bit unique to education lending, and part of that is because their repayment incentives are not something that is usually available in other types of private market loans. Not saying that they don't occur, but they're much rare. So a repayment incentive is something that allows for you to either receive an interest rate reduction or some sort of a loan balance reduction or maybe a credit to your account. Sometimes you may need to qualify for these. So think in this terms of if you sign up for ACH or AutoPay, where you set up a checking or savings account to have your monthly payment taken out of a checking or savings account electronically. Sometimes lenders will offer you an interest rate reduction in order for you to do that. It saves them time, it saves them money, it's easier for you. And in order for them to do that, they will incentivize you to sign up for it by giving you an interest rate reduction. Sometimes there may be a credit to a loan balance. So making 36 or 48 payments on time and in full amounts, you may potentially find that you can get $200 or something like that off of your loan, basically reduced from your principal. Those are what we call repayment incentives. And there may be some eligibility requirements depending upon who you borrowed from in order to qualify for these repayment incentives. So, talking a little bit about interest and capitalization. So, if you were a student that chose to pay the interest while you were in school, your chart would hopefully look somewhat similar to the chart on the right. If you chose not to pay the interest while you were in school, your graph or chart would look something similar to that on the left. And essentially, you both borrowed $20,000. However, the person that deferred their loan while in school had interest accrue to the tune of about a little under $6,600 while they were in school. That $6,600 is added to the $20,000, and then over the next 10 years that the student would be in repayment, when that 20,000 and the 6597 is added together, the next 10 years would have roughly about $12,061 in additional interest accrued on that loan. However, on the chart on the right, if you borrowed $20,000 and you paid the interest while you were in school, when you went into full principal and interest payments for the next 10 years, you would only have been responsible for about $9,097 in additional interest because you took care of the interest the interest accruing while you were in school. It tremendously cuts down on how much interest accrued on the life of that loan over time, roughly $2,964. By paying the interest while you're in school, you saved yourself a little under $3,000 over the total cost of the loan. That's the power or the impact of capitalizing interest and taking care of or being responsible of the interest on your loan while you are in school. If you are moving on to graduate school, let's say you didn't take advantage of this while you were in undergraduate school, but you might be moving on to graduate school, this is certainly something to consider if you have the means to do so in order to save yourself some money while you are attending graduate school. But again, you're not required to do this, and if you're not in a position where you can pay the interest while you're in school, that is fine. There's both the federal and the private lending does allow for loans to be deferred. You just have to understand that there might be a little bit more of a cost on that loan over time. So, for those of you that have borrowed loans while you're in school and you're separating, here's a list of a couple of things that you will want to make sure you do. So, again, we've covered it already. Make sure that you understand the difference between your federal or private loans and figure out which ones you have. You're going to want to make sure that you have all of your servicers and your contact info available. So, if you have a federal loan, you borrowed from the United States Treasury, and the federal government and Department of Education have contracts with certain servicer companies throughout the United States to have those loans serviced on their behalf. And you should have their information, but if you don't, we'll show you where to get to it here in a second. If you have a private loan, you may have borrowed from a lender with a lender name, and that lender and their servicer entity might be the same name. However, there is a possibility that you may have borrowed from a particular lender who utilizes a third party as a servicer. So there will be a difference in name from who you lent or who you borrowed the money from to who you're actually paying the money back to. So you'll want to make sure that you understand the differences between those two and that you understand the contact info and understand um, that you may be making a payment to somebody other than who you initially, the name of who you initially borrowed that loan through. If you do have copies of your promissory notes, your disclosure statements, emails, all of that, if you have actual paper copies, keep those all in a central location or file. If you do not have them, or you've been relying on an electronic version, maybe through your lender's portal or through the federal government's portal, it might be a good idea for you at least to either get a paper copy or save to your desktop or to your personal computer a copy of the promissory notes and not to just rely on an electronic access through a lender portal. You may want to go ahead and download those yourself. You'll also want to kind of get an estimate as to what when you enter into repayment, what your monthly payment will be and when they're due. This is a great time during your grace period to outline all of that and to know what it is and your responsibilities are going to be. And you have a few months in order to get a lot of that in perspective and figure out on month 7 how you're going to be making your monthly payments. For those of you that have federal student loans, you can go out to studentaid.gov. You can see it here on the website or on the slide. This website is kind of a central area for all federal student loans. Studentaid.gov allows for you to go out there. You can go to the loans section. It allows for you to log in. It will download all of your federal loans. And then it will even allow for you to take a look at various different repayment strategies and various different repayment programs and the effect that those will have on your federal student loans. If you have a private student loan, there is no central repository for all private student loans. So if you borrowed from lender A and then next year you borrowed from lender B or next year after that you borrowed from lender C, there is no central repository because again, you're borrowing from different private entities. However, you may find that your information should be out on your credit report. And if you wanted to visit annualcreditreport.com or another type of reputable credit reporting agency website, you should be able to go out there and see the loans that the student loan providers that you borrowed through should have their information out there as an account. And you would simply just look for the name. You'd be able to find the dollar amount and then work on establishing contact information and setting up your portal or reaching out to them about any repayments information and advice that they can give you at that particular time. So your repayment options for federal student loans, again, you go out to studentaid.gov. It allows for you to use a loan simulator to take a look and explore all your various different repayment options. But some of the things that you may want to consider, because your loans have a grace period, which is roughly 6 months, and you would be making your payment in month 7. If you have left undergraduate school, let's say here in May or June, and you think that you want to go back to graduate school, or you may want to obtain another type of degree, if you start back into a program within 6 months, your loans will roll back into deferment. You just need to be making sure that you're attending school at least half-time status and you're not in default on any other type of uh, federal aid program. So you'll want to make sure that you kind of get an idea or a sense as to when you want to start that next level of education. If you wait longer than 6 months before you're going to start your program again, you will officially enter into repayment. And you may have to make a few months worth of payments until you start your next educational experience, whether that be graduate school or continuing education. Um, when you start back into school, If you're attending at least half-time status, your loans can go back into deferment again, and that will help you. However, when you leave that program, whether through graduation or maybe you take some time off, you will immediately enter back into repayment on the loans that you have already previously entered into repayment on. There is no extension of the grace period. So you'll want to make sure that you consider that. Um, you can, like I said, you can take a look at public service loan forgiveness. You can take a look at various different repayment programs, and payment options. You can even also explore consolidating your loans. If you're in a situation where maybe by chance you have a couple of federal loans with one servicer, and unfortunately you have another federal loan with another servicer, you may find that consolidating your loans together may allow for you to get all of the loans combined to where you would only have to make one monthly payment, and whatnot. So that's something that you can explore out on the studentaid.gov website. If you have, like I said, all of your documents and everything together, that's great. If they're in paper form, put them in a central location. You may want to think about a, lockable firebox or so to kind of keep that information handy. If you have all of it in electronic version, keep a separate folder on your laptop or on your personal computer, and make sure that you have, you know where the access is in case you need to look anything up in the future. Moving forward, if you receive information in the actual mail, make sure that you open up every envelope and read it thoroughly to make sure you understand what is happening. Some lenders will communicate via mail, some lenders will communicate only via email. So, if you have an email by chance that has a ton of spam that's received year over or, day after day, you're going to have to kind of go down through and make sure that you pick out the pertinent emails from your student loan providers or their servicer and make sure that you read those and understand what is being communicated to you. Many times lenders will give you information about repayment programs, repayment periods, when your payment is due. All of that will come in either the form of a paper piece of mail or an email. Make sure that you notify your loan servicers of any name and address changes. You're leaving school. You may have been using a .edu email from the college or university that you've been attending. That will be shut down, and it'll be shut down fairly quick after you leave school. So you'll want to make sure that your lender or servicer has your most up-to-date personal email. You'll want to make sure that they have any address. Many times you've applied for loans while you were attending school. You might have been using your school address for any correspondence and such. So you'll want to make sure that you give them your updated address, the address that you're going to be living at when you leave school. For anybody that may have a name change, maybe through marriage or through other legal means or so, make sure you communicate that to your servicer as well. So, if you want to consider this, consider downloading the app or the apps of your loan servicers. It does make it easier for you to map and manage your loans. It's something to kind of consider because you will have a relationship in making these loan payments over the next 10 to 15 years or so. A lot of times apps will have access to additional information that you may not necessarily have available through the main lender or servicer's website. So something to consider. So, when you are making payments on your loans, when you get your coupon book or when you start to get your schedule of payments, whether that comes in an electronic form or so, you may also have access to what is called an amortization schedule. And an amortization schedule is basically a breakdown of every single monthly payment that you will be making over the next 10 or maybe 15 years or so. And it will show you how much of your payment is going toward interest, how much of your payment is going towards principal, and if you possibly had any fees, whether that be a disbursement fee or a repayment fee, or maybe you have a late fee or something like that. That amortization schedule will show all of that broken out so that when your monthly payment is submitted by you to the lending institution or the servicer, your monthly payment is going to pay off the fees first, It will then pay off any of the interest that accrued on that loan, and then any of the remaining payment will go towards your principal. So that initial amount that you borrowed way back, from year one to year two to year three to year four. You may find that looking at an amortization schedule, that the majority of your payment could potentially be going towards interest first, with not as much of it going towards the principal. That is pretty commonplace, whether it be on an education loan, a federal student loan, an auto loan, or a mortgage loan. But if you take a look at that amortization schedule, you will see over time that the interest percentage will go down as you constantly make monthly payments. That interest portion will go down, and more of your money, your monthly payment, will be going towards principal over time. So maybe for the first few years or so, yes, you may be looking at paying a lot more toward interest and less towards principal. But over time, that will start to balance out. It will then become equal. And then eventually, over time, you will have more of your payment going towards principal than it will interest. And then that's when you're really starting to pay down the bulk or the majority of your loan. The more principal you can get paid down, the less interest that is calculated and can accrue on your loan. Some of you may be saying to yourself, I've got multiple loans. I've got some federal loans, I've got some private loans, and of course, I have them for all 4 years or maybe even into graduate school. I'm really struggling with all the different types of loans that I have to pay back. Do you have any strategies? Some people may find these two common ways to get rid of their debt kind of helpful. Some students will probably think in terms of the snowball approach. What you want to do is take a look at all of your loans and you want to pay off all of the smaller balance loans first. Let's say you've got 7 different loans ranging anywhere from $5,000 up to $25,000. Some of you that think that the snowball approach is better for you may want to pay off your one or two loans that are down or around $5,000 to maybe $7,000 first. And then that will take out, of the loans that you have, that will reduce it by two to make it a little bit more manageable for you. And then, of course, you'll dedicate paying off the next loan above that, maybe your $9,000 loan as quickly as possible, and get your count down as to how many loans you have that you would be paying on. Um, the other approach is what we call the avalanche approach. So you have the same 7 loans over the 4 or 5 years that you were attending school. But what you're doing is you're looking at the individual loans based on the interest rate, and you're trying to put as much money as you can toward the loans that have the highest interest rates, separate from whether or not you may still have to make anywhere from 1 to 7 payments on a particular loan. So the idea behind that is that you are trying to pay off the loans that have the highest accruing interest first in order to save yourself money over time. And what you're doing is you are potentially having to pay, toward 5 or 7 loans per month for a longer duration. For the snowball approach, your peace of mind and your peace comes from reducing the amount of loans that you have to pay on down to just a couple, regardless of what those interest rates are. Both of them are approaches. Both of them will help pay off your loans. One of them will help save you a little bit more money in the form of paying down interest faster over time, but they are not, it's whatever works best for you. And if having to pay on multiple loans over multiple months is something that really stresses you out, you may want to look at the snowball approach and see which loans you can get paid off faster so that you can get the amount of loans that you have to pay on monthly reduced. We talked a little bit about auto debit. Many lenders, as well as the federal government servicers, will have some sort of an incentive for you signing up for what we call ACH or auto debit benefits. If you set up a checking or savings account to where the servicer or the lender can get or access your monthly payment on a scheduled and approved dollar amount that you authorize either each and every month or that you establish at the beginning. The entity, the servicer or the lender, will sometimes throw an incentive your way to sign up for that. And basically, by doing that, it gives them peace of mind. They know exactly when your payment's coming in each and every time. They control it when they download and ask for that money. and it allows for them to predict and do it through an electronic means versus receiving a paper check or some sort of a one-time payment by which sometimes a customer service agent has to work that loan or work that loan payment or that check, which obviously sometimes can end up costing the bank or the lending institution money. So you'll want to pursue that. You can look on your promissory note, and again, the student lending portal, either in the federal government site or your particular lender that you utilized, should have information about any type of benefits or features, repayment incentives that are available to you. And they should have some sort of an enrollment form regarding ACH or autopay. If you had to take out a loan where you needed to have a cosigner assist you in getting approved for that loan, if it's somebody that you do not have regular contact with, that's understandable. But now would be a good time to reach back out to them and let them know that you have graduated, that you are moving on to the next phase of your life, and that in the next 6 months or so, give or take, you are going to be starting back into loan repayment program. It's good to touch base with your cosigner so that they understand it. If they have not logged in and created their own portal access to that loan through the lender's or servicer's website, remind them that they should. But basically, it allows for you to touch base and just kind of bring them up to speed as to what is your responsibility, how you're going to be taking care of this debt moving forward. Remind them that if your lender does have a cosigner release, that if this is something you want to do, that you could potentially be working towards this, and remind them that they might not be on the loan for the life or the duration of the loan, however you want to handle it. But now would be a good time to touch base with your cosigner in regard to that information. If you find yourself struggling, and you've gone through your grace period, you've started into repayment, maybe it took you a little bit longer to find a job or a career to start off with, and you're just not making as much as you thought that you were. Please understand that the federal government has various different deferment and forbearance options. Now, we talked about a couple of the deferments already, the most notable one being in-school deferment. As long as you're in school, at least half-time status, you can have your payments deferred. But if you do find yourself in some sort of an economic hardship to where money is not as available, you can call your federal loan servicers and talk to them about any economic hardship deferments that are available, or even what is called a forbearance, which is a servicer's discretion to temporarily suspend payments that you are making in order for you to get back on your feet and then resume repayment at a time where it is easier for you to make those payments. Many private lenders will have these programs too, so I'll be bringing that up in the next slide. But just to let you know that those are available to you on your federal loans. You can go out to studentaid.gov again to read more about them. You may even find that you can apply for various different deferments and such like that directly off the studentaid.gov website if you need to. Private loans, again, remember they were unsubsidized for the life of the loan. The repayment terms are going to vary by lender, and the grace periods could vary by lender. Many lenders do have grace periods, typically 6 months or longer. Sometimes, depending upon your program of study, you may find that you have a little bit longer grace period. But hopefully, that is available to you. Along the lines of federal loans, many private lenders will have various different deferments or forbearances, but they might be called something a little different. Sometimes some lenders may offer a deferment in the form of a residency or an internship deferment, which means that you have to qualify in an applicable internship or a clerkship or some sort of a residency program if you're going into the medical field that you need to be enrolled in and excelling in order for your loans to be temporarily suspended while you're in this program. Other lenders sometimes will also have other forbearance programs very similar to the federal government. If you're struggling and having trouble making payments, contacting the lender, you may find that they are allowed to put you in a temporary stoppage of payment, which is called a forbearance. that allows for you maybe over the next couple months to refocus, maybe get the potential bonus or something like that, or maybe get employed if you hadn't been employed yet. Allows for you to have all of that happen so that you can start up responsible repayment again in the near future. Remember, a lender has, if it's easier for a lender, then typically that's when they will, want to have their that money come back in a better time. So maybe I said that wrong. Um, when a lender has a student struggling, making payments, it's going to end up costing the lender a little bit more money in order to try and service that loan and try and get that payment. So if you are a student that is struggling, you may find yourself needing to reach out to that lender and be proactive. Let them know that you're struggling a bit. Find out what their options are to help you with this, and see if there's ways that they can either temporarily suspend your payment or maybe shift or change the monthly amount that you have to pay for a short period of time in order for you to get on your feet. If it ends up costing the lender more money because you are going delinquent or potentially in default, that is something that a lender does not want to have happen either. It's going to cost them more money over time. So many lenders will want you to be proactive versus them having to be reactive, and having to kind of, severely limit their ability to help you because you are either so far delinquent or maybe starting into default. That is really kind of hindering what a lender should be able to do for you, if you're in that program. So again, be proactive if you find yourself in a situation where you're struggling. Reach out to the lender, and see if there's ways that they can help work with you on getting back into responsible monthly repayment. For those of you that are wondering if there's any tax deductions or so for your student loans, the answer to that is yes. However, it's a bit cloudy. And the reason for that is because the IRS typically will publish their rules and regulations for the calendar year that you're currently accruing money for. So obviously right now, year is 2026, you're accruing money. You've accrued loans over the past 4 years or so. When you file your taxes anywhere between January and April of 2027, you will be doing so and looking for tax benefits and such that will most likely be introduced somewhere over the fall of 2026. And the reason because of that is the federal government and IRS can change some of their rules and regulations just prior to the tax filing season. It would be very difficult for us to comment on the various different programs and deductions that you would be eligible for since they're not set yet. Right now, we could tell you about last year's, but we're not get there's no guarantee that last year's deductions will be available for this upcoming year. So what we tend to do is remind students to go out and visit irs.gov, pull up what is called Form 970 or 970, and it'll allow for you to read on the various different tax deductions that are available for students that have student loan interest. As always, you can consult a tax advisor, or whatnot, and have them kind of distinguish some of your um, eligibility for the upcoming year. But on average, like I said, sometime in the fall, perusing publication form 970 on the irs.gov website is the best way to try and understand more about any type of tax deductions that you can take on your loan interest. Lastly, remember to stay in contact with your lender and servicer over the entire duration of your loan repayment. If there's any contact information that needs to be done, make sure that you do that either through an electronic means, through either email or through the student portal, or simply giving a phone call to the lender or servicer. You want to make sure that that gets updated as soon as possible. Again, read everything that comes through the mail for you. You're going to be getting a lot of information. Some of that might be marketing, but most of it is going to be information that you can utilize in order to plan on and establish good repayment habits. So make sure that you're reading everything, whether it be an electronic, email, text, or portal form, or if it actually comes in actual physical paper mail. And then lastly, if you have any additional questions, being proactive with your lender and your servicer versus being reactive because either you might be a little frightened or you just simply just didn't want to reach out or so. Being proactive with any future questions, being proactive with any questions that you have in regarding to making your full interest and principal payments is always better than kind of going delinquent, becoming delinquent longer, and then having the lender have less ability to help you out of that situation. So we've covered a lot of information today. A lot of these are great repayment habits. Some of these can be employed over multiple loans in the future. So it's not just specific for education lending. A lot of the features and benefits were, but a lot of the repayment habits are good information for you to have moving forward. And one of the places to learn even more tips and to get more financial wellness information and whatnot is on the Provident Credit Union's Enrich website. And you can see the web link here, providencecu.enrich.org. If you happen to have a phone available and you want to take a quick picture of the QR code in the bottom right of this slide, we'll stay here for a couple of more seconds for you to take that picture. It will hyperlink directly to Provident Credit Union's Enrich website, of which then you can explore a whole myriad of different types of financial education tools and information and whatnot to help you better understand loans and better understand the financing process.